Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. She's been speaking to Jerome Powell all morning. We speak to Claudia Sahm of Michigan about this report. Claudia, this changes the dialogue for the chairman of the Federal Reserve System.
The Fed is going to look at 1 month and just kind of take it in context of what we've seen recently. Yeah, this month, these are not great numbers. It's a disappointment. I certainly looked at that unemployment rate. And yet we have seen solid gains. This does not change the story. And honestly, at the Fed and a lot of places, all eyes are still on the CPI and the inflation prints. So we still have an economy that's really moving and a labor market that's still working well, although not in the way that we've seen last year, where it was still just going really strong.
I know they're going to be day dependent, but I know that everybody listening across the nation and watching on YouTube wants to know from Claudia Sahm the recession metric. Now, you haven't had time to go out state by state and readjust your claim rule, but we've had a number of people this morning suggesting part of America is in recession. Is that true?
No, that's not true. The recession indicator that I put together, this is, it's calibrated. It's, looking at the national recessions that we've seen. There are times where we have disruptions at, local levels. Industry bases can be really important in a area like California with tech. And so you can see states or localities move in one way that the rest of the economy isn't. It's important to look at increases in unemployment rate. These are not good. And yet we shouldn't think of that as a recession or a problem.
Claudia Sahm with us right now. With markets moving, we had a lot of red on the screen. We've now lifted constructively. Small caps go up 0.4%. The Russell 2000, Lori Calvasina, to join us later. About now, in this 8 o'clock hour, we come to you commercial-free across Apple CarPlay and YouTube Bloomberg Podcasts.
And Claudia, just again, from the headline perspective, I think what's jumping out for a lot of people just looking at various reporting here is that headline unemployment rate of 3.9%. And there's an argument to be made that the Fed would, in fact, doesn't mind seeing that number go up because that may give them some maybe more ammunition to cut rates. How do you think about that argument?
Well, first, it's not a flashing red number. The recession indicator, the Sahm rule, takes the 3-month average. I mean, this is, conceptually, we should do this on any data release. And right now, that Sahm rule is up 26 basis points and the trigger is 50.
Yep.
Right. So we are still far away from, red alert territory. You never want to see it go up. We saw some times last year where it did, and then it got revised away. So this is not good news, but this is not just, hair on fire kind of news. And it shouldn't change anything the Fed is thinking today.
One of the things
that's just how they look at the data.
See, let me translate that for you out on YouTube live chat. Dr. Sahm just said Tom Keene was wrong. Okay, continue.
Just relax. Hey, how about these revisions here to the prior month? I mean, it's almost a 40% revision downward in that headline change in non-farm payrolls. Did their spreadsheets just not work last month?
No, the Bureau of Labor Statistics knows what they're doing. It's hard. We have an over $25 trillion economy. We have hundreds of millions of people working. It's really tough to get a good read. And when you think about it, we get that first read on the labor market like within weeks of the Bureau of Labor Statistics doing those surveys. So we're going to have noise. These are not... again, downward revisions, taking away a big number, that's not good, right? We'd like to see, big numbers going all the way forward. And yet it's not surprising. Measurement has been very hard throughout this whole cycle. And frankly, we get revisions like this. This is not unusual.
On a decile basis, or I'll let you go, you can divide by fifths or tenths. A decile, folks, is 10% of the people out there is the way I'm using this here. Are we lumpy and polarized in our labor economy, Claudia? Or can you say it's one America and you can aggregate, as Alan Meltzer lectured me years ago?
It really depends what you're looking at. I will say this labor market has worked for more of the deciles than usual. The recovery has been, and the wage gains that have been made, there's a lot of it at the bottom.
Yeah.
Now, they were starting from a very low place, so that's not necessarily saying a lot, but this has been a more quote unquote inclusive recovery than we have seen in a very, very long time. And the labor market is still in a very good place for low-wage workers, women, immigrants, people in marginalized groups. I mean, you name it, this has been a very inclusive. There's a lot of wins to go around. Now, if you ask people, they may not be feeling the wins.
Right.
And you ask businesses, they may not be feeling the wins. This has been very disruptive. This has been a real slog.
Paul, I'm looking here, and it's unfair to you and Claudia, but I got the Bloomberg terminal in front of me doing fancy mathematics.
Nice.
And the moving averages, to Dr. Sahm, folks, is correct. I use 3 moving averages. I'm not going to go into the math of it. And they're not gloomy down, the world's coming to an end. The operative word is they're flat.
Flattish.
We're just moving along on a summed moving average basis, as Claudia Sahm nailed there at 8:31.
Claudia, we also saw the labor force participation rate kind of come in at 62.5%, kind of steady. Give us context for that number.
That number is so important. Like, that's the piece of coming out of the big disruptions. I mean, you think 4 years ago, we had millions of people leaving the labor market because of the pandemic, because of care responsibilities. I mean, that was so disruptive. And we have not, on the population as a whole, gotten back to where we were 4 years ago. And yet we've made a lot of progress. Prime age people in their prime working years, they're back. We've made a lot of really turning the corner.
Right.
Last year on the recovery was coming from more workers. We solved a labor shortage with more labor and not fewer customers. The Fed can only do the second one, and we got workers back. So that's one that's really important, and we have to keep building on those gains, and we absolutely have to keep them. So steady as she goes there. That's very important, and the Fed is very much watching that number.
We got the luxury here. We can do this out of Michigan with Claudia Sahm. It's International Women's Day. Some people talk, others do. And Claudia Sahm is one of those that has not talked but done. And also someone named Betsy Stevenson as well at Michigan. Claudia, review the boom that we saw in women's employment, I'll say 30 years ago, and the changes now and how that folds into Paul's good question on labor participation. What's the women dynamic that we've seen pre-pandemic into this awful pandemic and now out of it?
We saw gains for women before the pandemic. I mean, remember, that was a really good expansion. We were in a good place, and COVID took a lot away from us. And what we've seen as we've come into this recovery, particularly the past few years, we're back on track. Right. And we are at a point last year, women's employment, women in their prime working years hit all-time highs. Right. This has been a generations long progress to give women the opportunity, those who want to work. And we're seeing it. And it's really important. There were some thin silver linings that came out of COVID. It's very clear from research that the work from home technology has helped open up flexibility for women to be working. We have an economy with we're getting more and more part-time jobs. People with caregiving responsibilities often need flexibility. They're getting it. Wages, I mean, you name it. We're making progress. It's been slow, right? This shouldn't be a 2023 story, but we are making progress, and that's a real testament to an economy that is working.
So we had a red headline just crossing tape recently. Fed swaps price in additional Fed easing in 2024 on jobs data. Claudia, does that seem reasonable to you? Maybe a little bit of an overreaction?
My heart goes out to people that really need to get this right because of their jobs. I mean, the Fed does not know what the Fed is going to do, right? Because they do not have the data. Jay Powell, every Fed official has told us over and over again, they are not confident yet. They need more data. Now, there are subtle differences in what they tell us about how close they are to confident or not. It's reading the tea leaves. If you don't have a really good Fed speak decoder ring, good luck, right? Like this is not, again, like we were talking about. I look at these numbers and I'm like,
whoa. Do you have a decoder ring for the Fed?
Well, that's what working over a decade at the Fed gets you. I mean, like you listen to the Fed speak, right? When yesterday Jay Powell said not too far, right, from getting confident, I was like, I mean, I'm as happy to hear it, but not too far in Fed land can be many months. Is
he wobbly kneed?
Pardon me?
He's wobbly kneed. Senator Warren went after him on regulation, that he was weak kneed or wobbly kneed or whatever. I mean, they really went after him yesterday, Claudia.
But that's their job. I mean, those hearings are for Congress to hold the Fed accountable. They should be asking the Fed tough questions. If they're not, we have a big problem in terms of Fed accountability.
Then there was Senator Kennedy from Louisiana.
Yes, Claudia, thank you so much. Claudia, I love doing this. Right now, and this goes, folks, to how we piece the show together. 3, 4, 5 days ago, I said to the great team we've got working 24/7, just get Calvasina. I just want to talk to her about the markets. And I get that 20 years trailing, 10 years trailing, the Russell 2000 is underperformed NVIDIA. I mean, as a generalization, or the magnificent whatever. But I said, get the magnificent Calvasina on, because if you go back to 2019, if the Russell 2000 just gives me a 17% pop, we're right back to record highs. Lori, thank you so much for joining us with RBC Capital Markets. To me, small caps are sort of maligned now. They're actually doing better than the zeitgeist. Do I have that right?
You're right, Tom. And, look, I was traveling. I've been traveling pretty much since the last week of January. And I got to the end of February, wrote my weekly, and I realized that actually in February, small caps had outperformed large caps. And if you looked at the relative ratio between small and large, it bottomed on February 7th. And I would not have known that. And I didn't know that just purely based on all the conversations I was having with investors in February, because it was like small caps are stuck in the dumps after that great November and December. They've gone right back in the toilet again. And all the while, they were slowly and stealthily crawling their way off the bottom.
Is there a leg here, folks? By the way, we're without commercial interruption here. We're thrilled to have Lori Calvasina here to get us forward. Lori, when everything's said and done, is now the time for Russell 2000 after this nice leg up? Can you say you've got the energy, the bid to get out to record highs on Russell 2000, up 17% from here?
So I think we can if a couple of things fall into place. So I think November and December, I think that trade was all about anticipating the Fed rate cut. So I think that part of the story is done. Small caps were maligned last year for their, what aren't really that bad, but were perceived as being bad balance sheets, and fears the Fed was never going to cut. Well, that expectation has shifted. If you look at positioning data, if you look at Russell 2000 PE data, we're basically back up to either, kind of averages on the PE or 3-year highs on the positioning, but we're not at all-time highs. We're kind of a middle innings trade just on a basis of valuation and positioning. I think what's very interesting is that today with this jobs report, you've seen small cap futures actually respond more sharply to the upside than large cap futures, at least initially off the print. I think what small caps are starting to react to in February is the idea that the economy is just hotter than anticipated. And typically we see that when the economy is running above trend, and trend is about 2.6% on real GDP, when you're above that 2.6% threshold, small caps beat large caps. And if we've been kind of around 2%, if we can get closer to trend and convince the market that we're in a sustainably hot economy, I think small caps are really going to shine.
All right, so small caps are going to shine. Any sectors that we should be focused on here if, in fact, the economy is going to hang in there? We're going to have, kind of some reduction in rates?
So one of the sectors that does tend to do well when we see consumer confidence improving, if you look at the Michigan sentiment data, and this is really true across the market cap spectrum, but I would say financials. And if you think about small cap in particular, we've been talking about two areas that are more on the cyclical side. One is consumer discretionary. It is a sector that tends to do well coming off of a recession low, and I am not in the recession camp by any stretch. But if you sort of think about the zeitgeist of, just having a better economic outlook, consumer discretionary stocks tend to do well. And we've also just seen they're very cheap in small cap relative to large cap. I also have been talking to people a lot about how consumers, our economists have done a very good job of showing how the economy and consumers at large, especially the high end, are less sensitive to short-term rates. But I do think the lower end consumer is still affected by short-term rates being high. And so if you get some relief there, I think that should help lower end consumers. And I think that should also help the small cap consumer discretionary companies.
So I know from your notes in the past, or you had a 5150 2024 S&P 500 target. We're pretty much there right now, a little bit higher than there. Does it need to take a look at that and maybe think about where that possibly could go higher?
Yeah, so it's a great question. We've been talking about that a lot as well in our recent meetings. So the 5150 is basically the median and the average of 5 different models that we use. The most conservative one of those models is rapidly improving, and that's basically our GDP test, which says, historically stocks don't do that great and kind of flat to 2% type GDP years. But of course, we're right on the cusp of that of 2%. So that model is starting to improve and head in a better direction. Our sentiment work has also been restraining our enthusiasm a little bit. AAII net bulls have been sitting right around 1 standard deviation. You're usually flat over the next 3 months when you get that. And so I keep looking for this pullback that hasn't happened. But frankly, our valuation model is what we've been talking about most in meetings. This one was spot on last year. It was telling you to look for 21 to 22 times trailing PE in the market and 47 to 4,800. I did not listen to it enough. Maybe I'm going to be guilty of that again this year. But right now, that model, which bakes in forecasts for inflation, interest rates, and GDP, is anticipating about 5,400 and a PE of over 23 times on the S&P at the end of this year. So that's the one, that points you to the bull case.
Lori, I was just wondering, in terms of leadership here, the technology, as long as we can remember, technology's been the leadership here, and Tom's been calling out NVIDIA and what a tremendous move it's had there. Is that still the case? Do we need technology to continue to be the market leader here?
I don't think you do. And I've actually been debating this with one of my colleagues internally. And this kind of goes back to the idea of small cap versus large cap. And look, I'm not going to make a comment on any one stock. Some of my clients have joked that the Mag 7 is turning to the Mag 1. But the reality is that if you just take a little bit of market cap out of those top 7 names, out of that Mag 7, just take a raindrop. It's a flood. If you take that, think of it as water, you take that, you put it into the Russell 2000, it's really enormous in percentage terms. And I think that's the way we have to think about it. I don't think you have to get bearish on the prior leadership. Just say, hey, there are some other parts of the market that deserve a bit of a catch-up trade. And one chart we've been having a lot of luck with, and I know I talked to you guys about this a few weeks ago, is just some Bloomberg data that your team has put together that tracks Mag 7 expectations on earnings and compares those to the rest of the S&P 500. And that gap on consensus forecasts, and these are not my numbers, this is just what's out there from the stock pickers, is shrinking to less than 3% for 2025. I continue to show that chart in most meetings, and I'm finding clients are kind of coming around to the idea the earnings growth advantage is just dissipating. And if you continue to boost GDP forecasts, Russell 2000, rest of the S&P, those earnings forecasts are going to pick up.
Thanks so much. Lori Calvasina with us. Ellen Zentner joins us right now. I'm going to cut to the chase. My chart of the week from many people, including your shop, is suddenly indications of a decline in wage growth. Are we going to see in this report tangible lessening of wage growth that rolls over into an ECI, wages and benefits, that finally falls back to 2019 levels?
Yes, I think we continue to see wage growth under pressure. In average hourly earnings, it's the mix effect. Who are we creating jobs for that can bounce that around? But we're not expecting a material slowing on the year over year. But you create a lot more service sector jobs than expected at lower wages, and you will get a further decline in growth in average hourly earnings. But as you said, the employment cost index is what really matters, and labor compensation is slowing. And that means that your buying power for consumers is slowing. It means that your wage pressures that companies would be concerned about continues to recede. And so I think, that underpins what should be a slowing economy this year. But I do still think that we're set up for probably stronger growth than people are expecting, even though slower.
Unemployment rate of 3.7%, that's kind of the headline. that feels like full employment. Is that kind of misleading? I don't know. I mean, if I'm the President Biden, I'm taking a huge victory lap here.
Yeah, well, all of these jobs numbers are something that the president can take a victory lap around. And I'm sure he'll take advantage of that. I mean, we do have a lot of people employed while still creating a lot more jobs. And I think when you've got the population growing this fast, I think when you've got immigration growing this fast, and the labor force growing this fast, you can create a lot of jobs and keep the unemployment rate lower than what normally would be the case.
There's been some concerns raised about where the jobs are being created here. Maybe they're concentrated in healthcare and some other areas. Is that a viable concern here, that maybe there's not a greater dispersion of workforce creation?
Yeah, so we like to see diffusion across broad sectors, right? Typically later in a cycle, you start to get diffusion to come in, and you're putting all your eggs in one basket, so to speak. I've not been as concerned about diffusion coming in as some others. I think a lot of the job surprises are in sectors where we should be having surprises, where we still needed to backfill a lot of labor, and a lot of it is immigration flows that are going into the top sectors that they typically go into: manufacturing, construction, retail, and leisure and hospitality.
You had a modeled recession 1,000,000 years ago, it seems now. Not that long ago, but there it was. And the great credit to Ellen Zentner and your team is you changed that way before anybody else did and said, you know what, it's just not as gloomy as we thought, and we've seen this huge prosperity. Why have we seen this prosperity? Is it just stimulus, or is there another answer?
Well, the $5 trillion in stimulus doesn't hurt.
I strongly support that idea. Continue.
Doesn't hurt. But that fiscal impulse doesn't last forever. But as that fiscal impulse was fading, well, we had put in place sound policies to boost infrastructure spending, to boost efficiencies in manufacturing facilities, to boost, clean, green energy spending. And so it's been another type of fiscal impulse as opposed to just what we think of as traditional stimulus. And so that's still flowing through the economy. At the same time, we've had incredible flows of immigration, and yes, undocumented immigration, but they work and they earn and they demand. And the economy is benefiting from that as well. And so the Fed has had to raise rates much further and faster than I think anyone had expected. We have survived that. And largely because of the gradual transformation of household balance sheets into a very low fixed rate from years and years and years of near zero interest rates. Mm-hmm. And so this just this confluence of factors that means that the cycle can lengthen. And I didn't even mention productivity, which is, all of this is culminated into a 2023 that was much stronger growth than expected.
And we saw those numbers just a couple days ago.
A larger deceleration in inflation than expected. And that can continue. To a lesser degree, that can continue this year.
And now, folks, with the sun up every longer day, I'm looking at NCAA March Madness and all, we go to Ellen Zentner for what matters. In April, do you fish the Yellowstone River in Montana? I mean, have you done that? You've done every other river in the West. But it's like prime season.
We do like the pre-runoff season. That's closer to Mother's Day when you want to hit that. It means that Mom is angry, but Mom understands.
Mom understands
that fly fishing is important, but you have to hit it just before the runoff.
Before what's the runoff?
So the runoff is when the snow melts and the rivers blow out. So you got to hit it before the runoff, and then you have to wait. And then you come back after everything recedes.
Are you like canceling? Wow. Did you call up, Ted and the rest of the crew at Morgan Stanley and say, I'm sorry, the Sierra's got 12 feet of snow? And is that like the best fishing ever?
Yeah, unfortunately, it's a heavy conference time. And in April, May, that's very heavy conference times, So, no, so but believe me, I'll get a lot done this summer.
Okay.
Jackson Hole. Well, I see you around Jackson Hole.
It's a rumor. Is the snow good for fly fishing?
Snow is excellent for fly fishing. You need a lot of it so that in the summer there's a lot of runoff and the rivers stay healthy.
It should be good this year then.
Bob, can you be
In
sure
some
we get
areas.
this out
Yeah,
on the
some
podcast?
areas.
I want fly fishing on the podcast. I don't care what she says about the job market.
I don't know. When I came on, when I started doing radio in 2003 with you, Tom, you and Ken, Ken and I would talk fly fishing.
That's all you talked about.
He also loved it, and you gave us the stink eye because you did not like that.
You got that right.
I don't know if folks have noticed, but Tom does not like the attention being taken away from him.
No.
And so Ken and I would bond over fly
chime in,
fishing.
Lisa. Ken Pruitt, trout the size of your leg.
Yeah.
Are they really that big out west?
They can be, yeah, they can be.
Like, what's the biggest fish you've ever caught?
Oh gosh, I've caught up to 24 inches, but you can get up to 32, which would be really
trout.
trophy size. Yeah.
Wow.
Yeah.
Do you have like fish plastic up on the walls, like the whole living room fish?
No, we don't. I don't have a lot of fishing decorations, but we have an entire. We took a kitchen and turned it into a fly fishing closet.
Okay.
And so all of our equipment is in there. Yeah.
Ellen Zentner, thank you so
you go,
much. There's news you
tutorial.
can use, folks. Coming up, she'll be in the 9 o'clock hour in a week or two as we look a tour of her fly fishing kitchen. Ellen Zentner on this Jobs Day, really interesting there about the productivity of the nation. Joining us right now, Cameron Dawson. She is with NewEdge. She's NewEdge Wealth. She's given us just wonderful perspective on the equity markets, and we're all nodding on another day of Nvidia up. I looked at price to sales, and we're at the it's surreal.
The key thing with NVIDIA, though, and this is the exception, is that its earnings estimates for 2025 are up by 4x over the last year, which has been a key driver of why the stock has moved up so much. You can't say the same thing about all the other semiconductor stocks.
Can you say it about Apple?
You certainly can't. Their estimates have been flat, but even a name like Broadcom, its estimates are up 25% for 2025. And so it does raise the point that some names are going up because earnings are going up a lot. Other names have that multiple expansion that's part of the lift. And that's where things could become more precarious if the earnings estimate revisions slow down. But we're not seeing that slowdown in estimate revisions yet.
All right, let's broaden it out to the market, Cameron. Do we need these big tech names to drive this market higher, or can other parts, financials, industrials, other parts of the market move this market higher? Who's going to lead this?
The lesson from 2022 is that you need the biggest weights in the index to work if the index overall is going to work. There were pockets in 2022 that did very well, stuff like energy, but tech was down a lot, and thus the market was down. So when it is such a big weight in the index, it has to participate.
So do we stick with these names? Do we add to these names? Do we start new positions in these names? How do we get some exposure here?
I think that you respect the momentum, but we have to be very aware that we're seeing parabolic moves higher.
Yeah.
I'd add a book to your book of the summer list, which is Walter Deemer's When It Comes Time to Buy, You Won't Want To. He has a page in there that says, parabolic advances do not end by moving sideways. They end by the reverse. Parabolic down or straight lines down. It's a quote from Bob Farrell. So I think that we have to keep that in mind. When you see advances this sharp, they typically don't end in a nice way.
Okay.
But not yet.
Yep.
And good morning to Mr. Deemer, of course, esteemed and at Putnam Investments over the years. This is ancient history, Putnam up in Boston. I got to ask you about Samro. I brought this up twice this week. I'm giving Samro way too much love. I mean, he doesn't deserve it. He had a spectacular essay that went beyond the normal blah, blah, blah about active versus passive, and particularly the time continuum, which, Cameron, you've been wonderful on. Not short-term idiocy, getting out 1 year, getting out 2 year. Why should I be in an active fund if I've got a 401k and a 3-year, 5-year perspective?
I think that the active versus passive debate should be one that is on a spectrum instead of a black and white. And what I mean by that is that there are certain indices where passive makes a lot of sense because they are so concentrated. Look at the Russell 1000 growth, where 50% is in the top 10 names. You look to the value index, though, only 20% is in the top 10 names, even smaller for small caps, even smaller for international. What that tells you is that you have a lot more shots on goal to add value through stock selection in less concentrated indices. And so I think that when we think about active versus passive, that's where you're saying, let's pick our spots carefully and use that fee budget carefully if we're going to be paying up for active management.
All right, so if we're going to be paying up for active management, what's an active manager going to tell me about valuation here? It feels like the stocks really off those October lows have moved so dramatically, yet as I think about the earnings over that period of time, I don't see a commensurate increase in earnings.
No, it has been all valuation expansion. I guess the good thing about earnings is that they're not being cut, so flat is the new up. But even if we look out over the 2-year forward, and this is important because when you look 2-year forward, you're effectively encapsulating all the hopes and dreams of earnings growth over the next 2 years. There we're trading at 18 times. That's the highest level that we've been at since 2021. Obviously a very different monetary policy environment. So valuation are stretched, which is why when in our active funds, we are looking for names that trade at a discount to the market. We're trading at about a 20% discount to our underlying indices. And we think the purpose that serves is that when the market eventually turns, and we know at some point it will, there's simply less air to come out of those names because they haven't seen the kind of heady valuations.
I'm fascinated by how quickly we've come. I'm looking at close SPX yesterday, 51.57. How do you frame out in your weekend note a reset to 5,200, 5,300, a Yardeni 5,400, and up and away to 6,000? How do you sit down with a quill in your hand and write the note?
Yeah, I think that when we all cast aside the expectation that you could see any downside and that there's no fear in the market, we always say that the only thing to fear is greed itself, which is this idea that eventually crowded positioning, eventually stretched valuations become a bigger issue for the market. The problem with that, though, is that complacency needs some kind of catalyst, meaning that you can have a complacent market that persists, like 98 through 2000. You need a catalyst for that unwind to happen. So let's say growth estimates start to come in. That's where your crowded positioning, your stretched valuations, and your chasing of all the strategists saying, oh, let's ratchet up the numbers in our targets. That's when that becomes an issue.
And it's interesting, Tom, you probably saw this in your inbox as well, but Torsten Slok from Apollo was out with a note this morning saying the strong uptrend in inflation expectations is forcing the Fed to be more hawkish. That could be a headwind for...
And off jobs day today as well.
Yeah, we'll see that off the jobs day today.
Cameron, where you are, it's not your remit, but to me there's a massive ambiguity about 8:30 this morning. Nobody... Basically, as a sophisticate, I'd say nobody has a clue.
Right.
Nobody has a clue, and then how do you interpret it, right? And there's been a lot of reasons to say, hey, let's ignore some of these numbers. I think the one thing to watch is that economic surprises have rolled over the last few weeks, which is the reason why yields have been moving a little bit lower. Yeah. But they've not rolled over enough to see GDP estimates get cut. You've gone from 1.2% expectations to 2.1% for 2024 this year already, and I think that's been another key reason behind the lift in the market.
Is it okay if we leave you without asking you about Duke and UNC?
Please don't.
Okay, good. Cameron Dawson, thank you so much. We're Duke and UNC free with Cam Dawson of NewEdge Wealth Management. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.